Hi, I'm Kent Ritter. I'm the CEO and founder of Hudson Investing and the host of the Ritter on Real Estate podcast. And I wanted to send you a message today because I want to share some thoughts with you that are probably different from what you're hearing in the news and probably even from your financial advisors. What do we hear about today, right? We hear about inflation, interest rates, stock market swings, elections, wars abroad. All of it creates noise. It's all noise. And all of that noise creates uncertainty. And the uncertain mind doesn't act. But you need to be acting because you need to be securing your financial future. And I'm telling you this right now because I truly believe that we are in one of the best real estate buying opportunities of a generation. And I'm not alone in thinking that. Some of the smartest people in the business are acting right now in a big way. For example, Howard Marks, who's a prolific investor. He's the founder of Oaktree. He's been investing for over 60, maybe 70 years. In 2024, at his annual conference, he came out and highlighted commercial real estate, particularly multifamily, as a once in a generation opportunity. And I'll explain more on why a little bit later. But look at some of the other firms, biggest firms out there. KKR, which is another prolific private equity firm, just invested $2 billion into a multifamily portfolio across the US. And Blackstone, who's one of the largest investment firms in the world, just invested in a big way with a $10 billion investment in multifamily assets. Why are these big investors, these expert investors, making these big bets on multifamily? And why do we all think that right now is a great time to buy? I think it really boils down to three things. And it's three fundamental truths that really haven't changed. First is diversification. And there's a famous econ quote, it's diversification is the only free lunch. What that means is diversification is the only way to improve your returns while also decreasing your risk. Second is that real assets like real estate historically have performed really well during times of volatility. And the third is that supply and demand is what drives prices, right? That's Econ 101. So why should these three things, though, matter to you? Well, let's start with diversification. It's harder and harder to find true diversification. Your financial advisor will tell you that diversification is a mix of stocks and bonds. But the difference between their perspective and the richest people in the world is that the richest people out there, on average, invest 40% of their portfolio into real estate and private equity because they know that you can't truly be diversified in just stocks and bonds. And they do this because they don't want all their eggs in one basket. When your stock market portfolio drops 20%, which just happened numerous times in history, they don't want their whole portfolio to be sunk. My question to you is, if that's working for them, if true diversification is more than just stocks and bonds, it includes real estate and other private investments, don't you think it's going to work for you too in your portfolio and you should follow suit? Well, let's unpack this even a little more. Let's zoom in on equities because I think this is a really interesting thing that's developed recently. The S&P 500, when I was at IU studying finance, we were always taught that you diversified in equities through the S&P 500. You could invest in 500 stocks and be set for your equities. Well, what's changed is that right now, in reality, the top three stocks, Apple, Microsoft, and NVIDIA, make up 20% of the S&P 500. So you're not really investing in 500 stocks. I mean, you're really heavily invested in those three stocks, up to 20% of that whole piece of your portfolio. Then if you take that out to the top 10 stocks, 7 of which are those magnificent 7, all tech stocks, right? That's 34% of the S&P 500 is made up of 10 stocks. That's not diversification. And if you look at the expectations of those 10 stocks to continue performing, I mean, their expectations and multiples are sky high right now, and they have to keep hitting that to continue to have their stock prices increase. So when you look at what used to be the bastion of diversification, the S&P 500, it really is made up, up to a third of it of just 10 stocks right now. And 20% is just 3 tech stocks. So you got to think broadly about, is that truly still giving me the diversification I'm seeking. So you have to look outside of stocks and bonds for true diversification. And I think one of the best places to look are real assets and in particular real estate. And that's really because of three reasons. The first is real estate is a fantastic store of value, meaning the prices don't fluctuate up and down with 20% swings like can happen in stocks and other paper assets. Two, it's a fantastic inflation hedge. Typically prices, as prices move up with inflation, so do values of real tangible things like apartment buildings. And three, they're extremely tax efficient. So, it's easier to keep the money that you've gained than to make more money. And if you think about the return profile being most of your returns coming as long-term capital gains being taxed at 15 to 20%, versus, let's say, the interest you're getting in your savings account, which is ordinary income, which is taxed at, on the highest end, 40%, you can see that you're being taxed double in some cases on that income versus the gains that you would make through your real estate investment. The first two of these, right, talking about diversification and talking about just holding up well during volatile times, is mainly about avoiding risk and de-risking your portfolio, which is how you don't lose money, right? It's extremely important. It's Warren Buffett's and should be all of our number one rule is first, don't lose money. But it's this third aspect about supply and demand and what's happening right now with apartments and renting that I think is really exciting and really unique, and why right now in August of 2024 is a great buying opportunity. So as we know, right, if you've taken any econ class, supply and demand drive prices. I mean, think about anything. Think about rookie baseball cards that are extremely rare, right? Very expensive. Think about $1,000 Jordans, right? Tennis shoes that are extremely expensive because everybody wants them. Think about famous art, right? It's worth millions, hundreds of millions of dollars because it's rare, because the supply is limited and the demand is relatively very high. Right now, that's exactly what's happening or about to happen in multifamily. We are in a really unique position right now because for the first time in 13 years, asset prices for apartment buildings have decreased. This hasn't happened since the great financial crisis. And that's only because interest rates are high. And interest rates are high only because inflation is high. But guess what? Inflation has come back down. And the market believes 100% that there are rate cuts coming in September, and those cuts are going to continue. And as interest rate comes down, the cost of debt becomes cheaper. And all of a sudden, those assets that were discounted only because of high interest rates are no longer discounted and are worth, exactly what they were worth a couple years ago, and even more as rent continues to increase. So this price reversal in multifamily assets is temporary, and it's almost gone. As rates start to decrease in September, we are going to see asset prices start to increase in lockstep, and those discounts are going to be gone over the next year. So that all makes sense, but what does that have to do with supply and demand? Well, the other piece that's extremely interesting right now, the other implication of what happened with really high interest rates is that apartment construction ground to a halt. It almost completely stopped. If you look out into 2025 and 2026, there's hardly any new apartments being delivered. And I know this because with our data sources, we can easily track the permits that you have to apply for, building permits to begin construction. And they're pretty much non-existent. And I also know that it takes about 2 years to build an apartment building. So if there's no permits being had right now, you know that over the next 1 to 2 years, there's not going to be many deliveries of new construction. So supply is going way down. But while demand continues to rise, more people are renting and they're renting for longer, right? Whether it's millennials, Gen Z, baby boomers, everyone's renting. And so go back to where I started with demand increasing while supply is stopped, right? In that scenario, rents have to go up. You have less supply, more demand. And many experts believe that in 2025 and 2026, we're going to see similar rent growth that we saw after the pandemic. Because what happened during the pandemic, right? Building stopped for about 2 years. And then what did we see? we saw 2 years of rent growth of 5, 6, 10%. And I truly think that's going to play out again. So to wrap this all up, we are in a once in a generation buying opportunity for multifamily real estate, specifically the next probably 12 months, as prices are still depressed due to high interest rates, while demand is really coming online, and it's going to cause rent prices to soar in 25 and 26. The massive investment firms, right, the Blackstones, the KKRs of the world, are putting billions of dollars into multifamily right now because they understand this, and they understand this window, and they're deploying their capital back into the market. They understand that you need to have real estate to be diversified, performs well during volatile times, and that we have this small buying window before prices really go back through the roof. So I hope this gives you a different perspective as you take action to meet your financial goals. My team and I are always here to discuss and answer your questions. They're just as passionate as I am about creating wealth, and we're truly on your team as you work through understanding your financial portfolio and how to allocate your resources in the best way. With that, I hope you all have a great rest of the day. Thanks so much for listening.